So, guys, before we start with the session is purely educational, and whatever we would be discussing is for educational purposes only. Although we will avoid talking about stocks throughout, but again, if any names so as to ascertain as a case study is discussed, that should not be construed as any kind of buy, sell, or hold recommendation. The views are individual, and the idea is to communicate the thought process so that you can apply that in your framework and improve as a good investor. So today we have with us Anshul Saigal sir. He headed portfolio management services business of Kotak Asset Management till November this year. He has expertise in behavioral finance, and he firmly believes in value investing principles. Overall, 22 plus years of experience in Indian capital markets, out of which 6 with Kotak Portfolio Management Services. Prior to this, Sir has worked with JP Morgan Equity Research, ICICI Bank, and Chartered Bank, where he analyzed equities and corporate credit. By education, Sir is an MBA from MDI Gurgaon, and prior to that, he did his engineering in industrial engineering from SIT Tumkur. So he is an avid reader with particular interest in behavioral finance, which we would be discussing during the course of this session. And he's a as on today, if you ask, Anshul sir is a private investor since his tenure at Kotak PMS ended in November this year. So a very warm welcome, Anshul sir. And just in case I missed anything on your introduction, would request you to add to that.
Thank you, Prince. Thank you for such a nice introduction. Um, Thank you, friends, for being here. It is my pleasure to be speaking with you. Thank you for making the time.
Great, sir. So, Anshul, sir, like how it all started for you? I mean, basically, this is my first question. All my sessions will try to explore how had been the entries of our guest in the financial market. So, if I ask you, like, how any family legacy, or you are the first one who started, and how it went for you?
Sure. So, I come from an engineering family. My father was an engineer, my grandfather was an engineer, and we had a engineering business, plastics molding and mold making. And no one in the family had any, that is my father's side, had any sort of interest in equities or investing in general. They were of the belief that you work hard, create something, create goods, sell them, and make money. uh, Investing in the markets or putting your money to use was considered as gambling, and which is why they all stayed away from this exercise. Although I hear from my mother that my great grandfather, maternal great grandfather, was he had a cotton and stock trading business in Karachi and Calcutta, and that was quite a thriving business prior to partition. And maybe I've taken it from him that I'm in this field and I'm so avidly interested in this field. How it all started for me is that I joined MDI after my engineering to do my MBA. And I happened to do this one class called Behavioral Finance and Business Valuations conducted by Professor Sanjay Bakshi. And he spoke in that class about the concept of buying a dollar for 50 cents. And that intuitively struck me as a very interesting concept, that you're buying something that is worth 100 rupees for 50 rupees, which means that you're buying it at a bargain. At that time, I didn't understand that how is it that there can be a bargain in the markets? How is it that stocks can trade at bargain prices? But then it kind of induced that interest in me, and I read much more. I started trying to understand what is this concept and how is it that equities are trading at bargain prices versus their true worth. And over a period of time, it's become not just a profession but a passion, and it is a hobby. Everything, I mean, this is the one thing that interests me in life. And whether it is a, you can say that it is a profession, a hobby, a passion, whatever, but this is what I do, and I quite enjoy it. It's been 20 plus years since then, and there has been no looking back.
Great, sir. And what could be better than being taught by Professor Bakshi, sir? Definitely,
Correct.
that's you are lucky on that front. So, sir, how had been evolution on the learning front? Because 22 years is a long time, and when we all start initially, the things are different. And as we progress in our journey, we learn the nuances, we improve our process. So how it had been for you, and even the markets have evolved over a period of time, and you can say the market are more discovered at this point in time. So please walk us through your evolution and experience of last two plus 22 years.
Right. So what happened, Prince, is that initially, since I was influenced by Professor Bakshi, I read a lot of literature and books that he was recommending, and which I kind of came across in that time. Most of these books were either written or influenced by Warren Buffett, Benjamin Graham, and mostly them, and then later on, of course, Charlie Munger. Now, if you followed Benjamin Graham and Warren Buffett in the initial days, they always spoke in terms of a margin of safety, and why buying something that is worth 100 at 50 is the right strategy to follow. Now, and there was a concept of cigar butts that they used at that time, which meant that most of the cigarette has been smoked, and there is the last puff which is left in the butt. You take that puff and then you throw the cigarette. Essentially, what he means by that is that you're buying even less quality companies at bargain prices. When that bargain goes away, that is that 50 moves to 100, you sell that stock and you're happy that you made that 100% returns. That was the evolution, or you could say that that was the starting point of all my investing. That you buy even average quality companies at cheap valuations, take the last puff out of the cigar, and then throw the cigar. That evolved into special situations investing, in which I did particularly two types of investing. One is where I was looking at arbitrages, which is that you look at buybacks, delistings, etc. And there is an institution which is guaranteeing a certain price, while the instrument is trading at a discount to that price. And when that price is achieved, or somewhere close to that is achieved, you make that arbitrage and then you sell that stock or instrument that you're holding. And the second type of special situation was corporate restructuring. I didn't do much of merger arbitrage because that involved long and short side I wasn't too keen on taking on. And so I focused on corporate restructuring, which meant that you were looking at demergers from demergers, spin-offs, etc., from existing businesses. And these demergers gave you two types of opportunities. One was compounding opportunities within the larger company which got demerged, and these were less understood businesses because they were residing in the bigger company, and when they got demerged they became standalone entities, and you could do a better analysis of valuation on these companies and hence make money in their value unlocking. The second, of course, were companies which were called stubs, which is the company that was left behind, which was an average company. But because everybody sold it, that is, all the investors who got shares in that company, they sold it. The stub started trading at a discount. You bought it, made a little bit of money on that, and then you sold it. That was the second sort of step in my evolution. And then third, I got influenced by what people like Charlie Munger and to some extent Joel Greenblatt spoke about, as also if you read the book Margin of Safety by Seth Klarman, he also speaks about it. And there is a very interesting and underappreciated book by Michael Mobasil. It's called Expectations Investing. I read that. These are some books that really influenced me, and I started evolving towards the process that I follow today, which is that you buy quality companies at bargain prices, bargain versus what they are truly worth. They may not look like absolutely cheap companies, but they may be bargains versus what they are truly worth. And then you ride these companies as they compound their earnings. So let me give you let me give you greater clarity on what I mean here. What happens is that if I use the metaphorical example of real estate, for all those people who are familiar with Mumbai, Malabar Hill in Mumbai is an upmarket colony, and prices in Malabar Hill are north of 1 lakh rupees a square foot. In comparison, a lesser upmarket colony in Mumbai is the Lower Parel, where prices are in the range of 50 to 60,000 rupees a square foot. Now, if you look at absolute price of 50 to 60,000 rupees a square foot, it may look like that is an expensive price as well. But for Malabar Hill, a 50 to 60,000 rupee price is actually a bargain. So for the quality that you're getting Malabar Hill, and if you get it at 50 to 60,000 rupees a square foot, you are actually getting a bargain. So rather than worrying about absolute price, what you should be worrying about is what you are getting in that price. Similarly, in equities, there are certain times when you'll find companies which are trading at 20, 25 times price to earnings, which on an absolute basis may look expensive. But if the true value of these companies should be 30, 35 times price to earnings, then actually they're a bargain. And it is that understanding that whether you are paying bargain prices for quality businesses or not, that makes all the difference. And this is the style that I follow today, where I try and look for quality businesses which are trading at bargain prices, and I understand what will be the trigger for these valuations to get unlocked, that what will lead to this 20 times price to earnings to become 30, 35 times price to earnings. And then, of course, because these are quality companies, if they keep compounding and at a high rate, then you've got a long-term winner at your hands. This is the style that I follow just now. And if you give me one more second, or 1 more minute, I'll explain a little bit more about a point that you made, where you mentioned that this is a market which is very different from the past, where much of the value has already gotten realized, and it is difficult to look for value opportunities in this market. I tend to believe that till such time there are humans investing in markets, there will be bargains that will be available, because humans are prone to emotions, which vary between greed and fear. And when the fear is unwarranted, that is when you get bargains. The ability of an investor, or the quality of an investor in understanding where is it that expectations are actually lower than what reality is, it is there that you get bargains, and that always exists in the market. If I was to give you an example, let's rewind to 2021, the year 2021. If you recall, in that year, PSU banks were trading in the range of 0.2, zero point 0.3 times price to book, and their gross NPLs were in the range of 9 to 10%. Now, if your belief was that this gross NPL ratio is going to further expand from here, that is, that they're going to go from 9, 10% to say 14, 15%, then maybe there was further downside, or at 0.2, zero point 0.3 times book, the stocks would go nowhere. But if your belief was that the gross NPL cycle has largely played out, and that from here there is going to be a decline in gross NPLs, which will mean that provisioning will come off, and as a result, you will have earnings go up, then what could be a better bargain than PSU banks at that time trading at 0.2, 0.3 times book? You were getting a rupee for 30 paisa. I mean, what could be a bigger bargain? And what we saw over 22 and 23 is that gross NPLs came down. In fact, because of provisioning, net NPLs came down meaningfully. And these banks grew profitability by quite a margin over this period. Many banks, their profitability went up 4 or 5 times or even multiples of that. And as a result, they moved to one-time price to book, which meant that PSU banks delivered 3 times to 4 times, price action from those lows. And uh, that was a trade which was there for the sitting. And if you understood what expectations were built into those prices, there was so much money to be made in a year and a half, at a time when the markets have been, other than this year, last year markets were very volatile. At a time when markets were volatile, you made so much money in PSU banks. So this is the style that I follow today, that I try and understand what expectations are built in into a stock and whether those are real, unreal, temporary, permanent, depending on which I kind of gauge whether this is a bargain or not.
Right, sir. So, is it fair to assume, like, whatever the market situation be, opportunities will always be available? It is, I mean, we can quantify that if there is so much of euphoria, then probably comparatively less opportunities would be there, and other vice versa. And on the top of that, sir, don't you think, like, if you go 2 or 3 decades back from here, the market is more discovered, more information is available, and there are more screeners which are easily available to everyone. So, do you think, like, market discovery reduces the tendency of generating alpha?
You may be right there. You may have a point there. Given that there is so much data available, even, I mean, rather than going 2, 3 decades back, even if I go back to my time when I started investing, it was very scarce data that was available to investors to make informed decisions. And from then to today, there is an overload of data. But I can tell you that just like in those times, there were phases when there were less opportunities. I mean, if you go back to the Harshad Mehta phase, or you go back to the phase when there was a bull market in tech stocks, the number of opportunities available were relatively limited. But then the post Harshad Mehta phase, as also the tech bust phase, gave rise to multiple opportunities in the markets. To that extent, cycles remain the same. Even in the current markets, you will have cycles where for instance, if small and mid caps have run up 35 to 40% in the last 1 year, then the expanse of opportunities available today are limited. But if there is a correction, just like we saw at the time of COVID, then the expanse of opportunities that are available, that expanse goes up. So depending on cycles, you will always have limited opportunities or greater number of opportunities. To add to that, there is another interesting aspect of the market, which is that while there may be a larger cycle playing out in the markets. For instance, last 1 year, you are seeing the small and mid caps rally the way they have. But then, if you look at some of the rural discretionary segments, or you look at, say, the chemical space, their cycle has been quite contrary, or even IT for that matter, quite contrary to what has happened in the broader markets, what is happening in the broader markets. Broader markets, you are seeing a positive cycle, but in these segments of the market, you have seen a negative cycle. And so again, if you believe that this cycle is temporary in these segments, these sectors of the market, then many stocks which are down 40-50% from their all-time highs, while the broader market is trading at a all-time high, you can find bargains there. Of course, it depends on how much your patience is, how much time you have to stay invested in the markets. That return may not play out immediately, but on a risk reward basis, you have bargains, even in a all-time high market in certain segments of the market. If there is a correction in the markets, all segments will correct. But at least you know that you have found bargains in those segments that you're buying today. And when that market reverses towards the upside, because it is a question of when, not if, then you will be making money even in these segments. I hope I'm able to explain that, Prince.
Yes, sir, you did. So, sir, we are in an era of information overload, right? So, how you cut down on the noise and parallelly, when it comes to idea generation, so do you use any screening criteria or how, how you generate ideas before doing due diligence on those companies?
Um, Prince, there are multiple ways of identifying opportunities. Of course, the first criteria in identifying opportunities is to know yourself and what kind of an investor you are. If you are a quality investor and you don't mind the price that you're paying, then it is very simple. Look for high ROE companies. Doesn't matter what price they trade at. Look for their growth trajectory over the next 2 3 years. Run a screener for that, and then go ahead and build a portfolio of such companies, maybe 20, 30, 40 companies. Split your money in those and stay invested. If you're a concentrated investor and you're looking for stocks which have limited downside and substantial upside, then you look for companies which are trading at, you know, not at peak levels, but which have corrected from peak levels, where current ROEs seem to be compressed. But ROEs in the future will expand when the business of this company, that is revenues, and margins, will expand. And because current earnings are low, the multiple of these companies, that is price to earnings multiple, is also low. And you build a screener looking for these characteristics. Go ahead and build a portfolio of these companies and wait for the value to get unlocked. So depending on what kind of an investor you are, you will have to look for screeners. For me, I try and look for, the thumb rule for me is to look for companies where ROEs are going to expand in future. And that means that I'm looking for companies where revenue growth is going to be strong and where margins are depressed from the true margins of a company. Let me give you an example. Years ago, I invested in Britannia. And at the time that I invested in Britannia, the company's gross margin over the previous 2 years, this is 2014, had expanded by 2%. But that 2% expansion in gross margin was not showing up in their EBITDA margin, which had remained steady at about 6% for the previous 3 4 years. So when I dug deeper, I realized that this company has been premiumizing its products, but that premiumization of products is, the benefit of that is not flowing to EBITDA because the company is also advertising and promoting its products more. And so the incremental 2% profit was going into advertising and promotions. Advertising and promotion cost had gone up by 2% of revenues. Now, uh, I realized that the true margins of this company are not 6%. 6% is the absolute bare minimum that this company will see in terms of EBITDA margins. And as premiumization and revenue growth picks up, this company could see easily 9 to 10% margin over a period of time. And there was another play, which was that the key raw materials, which were flour and sugar, were at high prices. And these were commodities. So from high prices, there was room for these commodities to come down, which would mean that gross margins would expand further. Um, so and at that time, a company like this was available at 20 times price to earnings. A FMCG company having 40+% ROE, and a leader in biscuit segment was available at 20 times price to earnings, while all other FMCG companies were trading at 40 to 50 times price to earnings. So we built a big position here. And over the next 1 to 2 years, the revenues went up 14% CAGR, but margins went from 6% to 9%. And then today they trade at 14%. In this expansion of margins, the company's profitability went up quite meaningfully. And as a result, we saw the stock is up from that time. I mean, it was at that time 4 or 5 thousand crore market cap. Today it is probably 1 lakh plus crore market cap company. That is the kind of value we discovered in this name by assessing that the true earning potential or earning power of this company is not reflected in the current earnings of this company, and that in future earnings as reflected by EBITDA margins will go up meaningfully, which will lead to this company beating expectations and that leading to multiples getting expanded. Today, the company trades at nearly 50 times price to earnings, I think between 40 to 50 times price to earnings. So we got the benefit of earnings growth as also margin expansion in this company. So this is the process that I follow. That I look for companies where there is a material beat expectation on earning power in the future, which current prices don't build in.
Right, sir. So, I mean, you come across names, so you start with numbers or you look for the management or the business of the company first, and what hierarchy you follow? I mean, the process you just explained, sir.
Yeah. Uh, there is, there are multiple ways in which you can do this. Of course, over the years, by being in the markets, I have a fair idea of many companies. I may have over the years covered between 500 to 1,000 companies at some point. So I have a fair idea about how the companies run, what the management is about, and all that. But as a starting point, I look for businesses which are today out of favor. So I will look at, say, 20 companies which are today trading below their 52-week highs, materially below 52-week highs or all-time highs, and then start working on why they are trading so much below their 52-week highs. Many of these companies will have good reasons to trade below. That is that they were already trading at expanded valuations. Those valuations have corrected to fair numbers, and so, at fair numbers, it's okay that they're trading at these valuations. But there will be some companies where they are trading below fair value, and that is because these companies have seen temporary impacts on their earnings. And then I work from there. That I try and understand how is this impact going to reverse? What factors will lead to margins expansion or revenue expansion, and whether the market is expecting that to happen in future or not, and then take a call on these companies. So it is a combination of factors. I keep going through con call transcripts, through annual reports, through presentations, through management commentary in the media, etc., to gauge what the management is saying about current performance and how performance in their expectation is going to play out in future. If my analysis matches with their commentary, that's when I kind of get interested in a particular name to study it further.
And sir, what happens with the beginners in the market? I mean, everybody knows that they should read the annual report, con calls, and the presentation kind of thing, but they often get confused. And seeing the number of pages in the annual report these days, they get scared, and they only read the initial few pages, which are deliberately written in such a manner so as to project good about the company. So, what would be your advice, like how efficiently one can read the annual reports and these so as to gain maximum out of the document to build an understanding before investing in any company?
Um, See, the The basic purpose of reading an annual report or any literature on a company is to gauge whether this stock is whether this company and its stock are worth a purchase or no. So that is the one aspect that you've got to keep in your mind, that you are reading this annual report with a purpose. And so, what is most important, and this is what Stanley Druckenmiller says. He says that you can do a whole lot of analysis on a company and go nowhere because that analysis is irrelevant to the stock price of the company. But what you need to understand or bring into your analysis is the understanding that what will lead to this stock getting re-rated, what will make the stock move up. So all reading of an annual report or any literature has to be with that objective, that you've got to figure out there is so much information available in the media and in the annual report. Is it at all relevant for me to read or not? And so what I need to read is basically that information, or try and gauge out of various literature about this company, is that information which will lead to the stock moving up. More times than not, that information boils down to just earnings growth, being outstripping the market's expectations. So, all reading of an annual report should be with the objective that I need to figure out what will be the earnings growth of this company in future. Now, you can do that. I mean, just reading an annual report will not give you that clarity. You will need to understand the context that a company operates in today, the business of the company, the competitive scenario, management, the market opportunity. All of those things you need to understand, and then take a call whether this company will, the factors that I'm looking for will lead to the stock moving up or no. And so I mean, my point is that you've got to first understand that you are reading the annual report or any literature with an objective, and then go and identify aspects that fit into that objective, fit or defy your thesis about that company, and then take a call on either buying or not buying a business. um, I'll explain this with an example again. Now, I remember that we were looking at in 2019 a recent listing in the markets, which was a company called Polycab. Now, between the listing and around the first half of 2019, the stock had gone nowhere. It was trading at somewhat same prices in the range of 550 to $600. That got our interest, that this is a brand that we see all around. They're advertising everywhere. We know that this is a company which does well in general. The products of this company are well accepted in the market, and the stock has gone nowhere in this time that it has gotten listed. Despite IPOs being the flavor, everybody wanted to buy IPOs, but particularly of this company, no one showed any in this company. No one showed any interest. Then we went to see the annual report, and the aspect that we were trying to understand is whether this company generates cash flows, and whether the balance sheet of this company is strong or not, because that is the platform on which a business is built. If that platform is weak, then there is every chance that even an external negative event can impact the business adversely. What we saw is that the company was generating handsome sort of operating cash. The balance sheet was cash rich. It had 500 crores of net cash on the balance sheet, despite doing 200 to 300 crore capex each year, which told you that the balance sheet has been managed well. And as a result, the platform on which this company has been built is robust. So at least on downsides, we are protected. of course, we know that the brand is robust because we see it all around. And then the balance sheet confirms the fact that the brand is strong and that this company is built on good principles. Uh, Looking beyond that, if we looked at the growth of this company, then the company itself was guiding at 15% plus kind of revenue growth. And this was all publicly available. They were doing con calls, and they were also their transcripts are all available on the BSE website. If you listen to the con call, you would get this clarity again that this company is suggesting that it will grow 15%, and margins they expect it to be in a range of 11 to 13%, in that range. Uh, Now, uh, I mean, it is not very difficult for a lay investor to go out and check with certain dealers, distributors, sellers of this company's products as to what they feel about the product. We did that. We walked into regular stores in a place called Loharchal in Mumbai, checked with some dealers, distributors, and they had only positive commentary to give about the company. That they are a good set of promoters. They believe in win-win. They make us a lot of money, and they themselves make a lot of money. And the product is also of high quality. That again gave us confidence in the prospects of this business. And the stock was trading at only 15 times price to earnings at a time when names like V-Guard, Havells, and some of the other electric goods companies were trading at north of 35 times price to earnings. In fact, Havells was trading at over 40 times price to earnings. Now, there was a huge disparity in how this company was valued versus some of the other businesses within the same segment. If our belief was that this will grow at least at industry levels, and that that their balance sheet is strong, and their the cash flows of this company are going to be robust, which will be sufficient to fund the future growth of this company at high ROEs. They were generating 20 plus percent ROEs even at that time. There was no reason for this business to trade at that depressed valuation versus other companies within the sector. And lo and behold, 4 years later, the stock is over 5,000 rupees. I think 5,500 rupees or somewhere. Um, Multiples have expanded to nearly 40 times, and earnings, from 8,000 crore revenue at that time. If my memory serves me right, this company is 15,000 crore revenues today, and this is in or 14 or 15,000 crore in a matter of 4 years, and margins have expanded as well. So, so we bought into a name. Um, First, we assessed a name by figuring out whether the company has a robust platform. Then we assessed the name by figuring out whether there is growth potential in this business. And third, we looked at valuations, whether they were reasonable or no. And if growth did pick up, would it unlock value or no? If the answers to these were positive, then this was a favorable risk reward where downsides were limited. And if they got re-rated to sectoral valuations, then upsides were material, which in fact did play out over the ensuing 4 years. This is how we assess opportunities and try and gauge whether stocks are worth looking at or not. This is all for illustrative purposes. I'm not giving any recommendations. This is only illustrative examples, please.
Right, sir. And sir, you always the behavior element is of prime importance when it comes to investing, and you had been in the public money management. So, how had been your experience on that front, communicating with the clients? Because client communication is one thing which is very important and essential, right? And that only decides like what kind of even the client onboarding these days, when I talk to different guests, they have a set process before uh, dealing with people after onboarding is a difficult task, and they go about dealing upfront and deciding that the temperament of that client matches our investment philosophy. so that we are aligned on that front. So how had been your experience on that front, sir?
Prince, that is a very valid point. Generally, it is not easy to align expectations of investors with your investment process if the number of investors are so large that you can't meet with them on a one-on-one basis. At the end of the day, the investor is focused on the lay investor, that is focused on only one metric, which is the returns, and whether returns are firstly they are positive, and secondly if they are higher than the benchmark. That is what he's focused on. He's not focused on the the risk and what kind of opportunities you are investing in and all that. These are the two aspects that he's focused on most. To for that reason, you have to communicate very clearly with all clients through your writings, and tell them your process and tell them what you are trying to achieve in your investing. Our endeavor was to tell clients that this is not a 1 quarter, 2 quarter game, that this is investing is a long term game, and you have to be willing to bear periods of underperformance for long term outperformance, long term meaning 3 to 5 years. And as long as that is the expectation you build in, there is every chance that your expectation will be outstripped, and we will beat your expectations, and you will be a happy investor. But if your expectation is that we will make you more money than the markets in the next quarter, then there is every chance that you will not be a happy investor, and that this probably that is in our investment philosophy and our investment product, that this is not the kind of product you should be investing in. So alignment of expectations is paramount in investing, and that should be your endeavor to explain to investors what you are trying to achieve in very clear terms.
So, any few mistakes to your mind which you made in your journey, and we can learn from those, and especially the current market situation. What would be your advice to our audience in the sense like there is kind of euphoria, how they can place themselves in such times?
Yeah. So Prince, there have been, I mean, out of 10 stocks that I've invested over a period of time, probably in 7 names we made money. 2 to 3 names we would have either lost money or not made any money. So there have been errors of judgment over this period, and those errors can be of many types. There can be errors where you have misjudged the business of a company. There can be errors where you have uh, misassessed a cycle. That is, you have assessed the cycle to be favorable while the cycle has been adverse. There can be errors where you were unable to judge the quality of corporate governance in a company. There can be errors where the impact of the external environment on the business of a company, or the impact of regulation on a specific company can be adverse, and that can impact the stock price. So many ways in which you can make errors in this market, but it is important to have a checklist mechanism, and to learn from your mistakes, so that over a period of time the errors that you have committed, those errors keep getting eliminated from your process, and at least the same errors are not made in the future. um, just to tell you, I mean, to give you an example, we invested in Tata Motors sometime in 2018. Eventually, from 2018 to 2023, we would have made 3 times our money. But in that period, the stock went down for a 2 year period by 50%. So while we were right in the long term, but we gauged the cycle incorrectly in the short term, and it is very difficult for professional portfolio managers to explain to their clients that this is a cyclical downside and not a permanent downside, because investors are coming in with a time horizon of 1 to 2 years or max 3 years, and if names don't make money in that period, then they find it difficult to distinguish between errors and volatility. That is a professional hazard that all professional fund managers face, and we faced that in Tata Motors at that time. The cycle was adverse, stock went down, eventually it went up, but in that phase it was difficult to distinguish whether this is a mistake or just volatility.
Right, sir. So we got one speaker, Gaurav. Gaurav, you can unmute and ask your question, please.
Thanks, Prince. Thanks, Anshul, for sharing your insights. I have a question like in the current market scenario, when you see that market is has a lot of overvaluation across the categories, and at the same time, there is a run. I mean, FIs coming back and you see a lot of buying happening. So in this scenario, and if you identify a few opportunities, so how do you take a call that whether you should be in cash or you should go ahead and invest in some of the opportunities you identify? Because it's a dilemma right now. If market falls, then the same thing which you identified today, you may be getting that at a lower price, maybe a month or two down the line. Thank you.
That's a very valid question, Gaurav. I'll tell you two sort of markers in my mind to deal with a situation like this. One is that I make it a point that I don't go down the quality curve at times like this. Typically, what happens is then when there is a large re-rating in the broad markets and many stocks have been re-rated, the ones that have not been re-rated to the extent of the other stocks are ones which are either cyclical or those are low quality companies. And there is a tendency of investors at times like this to seek these names because they believe that सारी मार्केट भाग गई है, अभी इनका टाइम है तो इनके अंदर इन्वेस्ट करते हैं. But typically, what happens is that cyclical names and low quality names they go up less, and when the market turns, they go down more. So at times like this, it is important to go up the quality curve, not go down the quality curve, go up the secular growth curve rather than going into cyclical names at a time like this. That is one marker that I have when there is a broad based rally in the markets. The second point that you made is that if you find a name, how do you take a call whether you want to invest in it or no? See, uh, I have learned over the years that it is very difficult to take market calls. Now, if you go back even 9, 10 months, you will recall that most market participants were telling you that don't invest in small and mid caps, invest in large caps. What we have seen is that while large caps have gone up 16, 17%, but small caps are up 35, 40%. I'm talking of the small caps at the index level. So
Right.
clearly many informed investors, many knowledgeable institutional investors were not right in suggesting to people that they should be taking their making their bets basis market calls, because market favored small and mid caps at this time. So it is very difficult to take market calls. In fact, I would suggest that most people should just not focus on the macro market and take their calls. What they should focus on is where is it that valuations are reasonable, that this company has greater potential for the future than what the valuation suggests. Um, and if you find bargains, even in elevated markets, um, which are underappreciated by the markets, then I don't hesitate from investing in those names. Of course, if the market goes down, then these names will also go down. But since I don't know whether the market will go down or up, and if the market continues to be where it is or it goes up from here, then these names I will have missed opportunity, and these names will have gone up. I will not be invested in these names. So I, for one, don't mind bearing volatility. That is just my investment style. Some people may not agree with this. Some people may have an investment style where they want to be extra cautious on their capital and may want to hold cash on the sideline. But in my investing style, I would look for bargains even in elevated markets because I don't want to take market calls in general. Of course, I may become more cautious in such markets. That is, I may start, as I said, I may go up the quality curve, I may go up the market cap curve as well, because I believe that if a stock is liquid, it will have relatively less volatility. Illiquid stocks have greater volatility when the market becomes volatile. And so, to that extent, I may take those calls rather than holding cash in my portfolio. So these are two markers that I have in my mind while investing in markets as they are today.
Thank you. Thanks, Anshul. Prince, can I ask a follow up? I mean, if
Yes, please go ahead.
Please
yeah.
go ahead.
Yeah. So I think expanding on the cash thing, like for example, in case of funds, we see that generally people invest during high market and the funds may dry up during the low market. However, in case of a retail investor, there can be some source of constant fund if you are taking or investing for yourself.
Hello.
Gaurav, we lost you. You're not audible.
Any guidance
Okay,
from your
yeah.
side?
Gaurav, can you please repeat your question?
Hello,
Yeah, Gaurav,
hello.
we lost you when you said that. Yes, Gaurav, can you hear me?
Yeah. Yes, I can hear you.
You were suggesting that retail investors have a constant stream of income, so their case may be different. After that, we lost you. So please go ahead.
Yeah, so I was saying that because at times holding cash may help you during the fall. So, like you suggested that generally you are fully invested, and that may not be call at fund level or at the PMS that you may be managing earlier. But for a retail investor, what may be your suggestion as if you will you suggest the same thing or shall we have a different process on this?
For a retail investor, I always suggest that there should be an asset allocation. Now, you have to, again, it boils down to knowing yourself. Now, if you are an investor who will lose sleep if the portfolio goes down by 30%, then you have to position your portfolio accordingly. That is, you hold maybe 20-30% equities and diversify into other asset classes, which will protect you on the downside. However, if you're an investor who's comfortable with that kind of volatility, then holding some cash or having asset allocation to the extent that if there is in future some volatility, you can draw from your debt positions and invest in equities. That is a viable proposition. That is something that investors must follow. If you're a knowledgeable investor, for instance, in my case, where I have an understanding of risk reward, I have an understanding of individual stocks as also of the broader markets. I don't put my money in any other asset class other than equities. And like I said, I kind of modulate my portfolio depending on the market conditions. If the number of opportunities are less because markets have rallied as the way they have recent times, I would hold relatively higher quality companies, more liquid companies, larger companies, so that if there is a chance, because chances of volatility have risen at this time, And if volatility does occur, then my portfolio is relatively well protected. And my larger positions can be used as cash proxies at that time. I can draw from those and invest in some of the small and mid caps. That is something that I can do at times like that. So for knowledgeable investors, or full-time investors, that is an option that they can follow. For other investors, asset allocation is the best policy that can be decided basis knowing your own psyche and what will perturb you or not. Can we have the next question?
Yes, yes. So, Danny
Thank
sir,
you.
you can unmute. Thanks,
Gaurav,
Gaurav.
is that
Thanks, Anshul. Just wanted to say thanks. Thanks for your insights. Thanks, Prince, for giving the opportunity.
Hello, sir.
Yeah, Danny sir.
Hello, sir.
hello, Danny?
Yeah. Now market cap is
Sir,
over
you're
four.
not audible.
I can hear him, Prince.
Okay. Now market cap is over $4 trillion.
Right.
What do you see risk?
See, uh, the biggest risk that exists at this time is policy risk. What I mean by that is that there is for any stock or for the markets, earnings is a reality. If Nifty earnings are at, I mean, the expected earnings are 1,000 rupees or thereabouts for the next year, then that is reality. But what is not reality and what is a perception is the price to earnings ratio of Nifty. That if you are giving 20 times price to earnings to Nifty, why should it be 20 and not 15 or 25? Um, that is perception. Um, and that perception is decided by how the world looks at your the opportunity that your market offers. Now, in India's case particularly, what the world is seeing is that there is policy stability. There is a whole lot of favorable decisions which have been, or I should say, prudent decisions which have been made towards cleansing the system. For instance, the banking and NPS were at 12 lakh crores at one point. That number has come down to under 6 lakh crores today, and maybe over a period of time, it may come down to 2 to 3 lakh crores for the system. You have GST implementation from having multiple tax brackets within the country, and almost like having multiple countries within the same countries as regards tax. You have one tax sort of regime going through the country. You have stoppage of leakages through the UPI, through the Jan Dhan mechanism, and the mechanism of direct benefits transfers of subsidy, which means that capital is being used or put to use to in productive areas rather than unproductive areas, and filling pockets of a few. These and many other aspects of policy are what the world is giving a thumbs up to. And as a result, price to earnings multiple of this country has been re-rated from 15 to 20 times. Now, if the world believes that this policy stability will not continue going forward, if in 2024 the current establishment loses the election, then there is every chance that this multiple or perception of India may change, and that this multiple may compress going forward because the new regime will have a very different perspective on the economy and how to manage the economy. That to me is the biggest risk at this time. Aside from that, I wrote an article recently about a month back where I mentioned that there is equity markets move between a pendulum, and the pendulum is opportunity in adversity, which is if there is downside in the markets, then there is opportunity in that downside, to the problem of plenty, which means that if there is a lot of money available in the economy, then people tend to use that capital unfavorably or not imprudently. In fact, Warren Buffett used to make a statement saying that um, if you have if you have extra liquidity, then in the bladder, then there is every tendency to pee it away. Which means that if you make a lot of money in the markets and in your businesses, then there is every tendency to deploy that money in inefficient ways. For instance, you can do a lot of acquisitions. You can deploy that capital in unrelated businesses. You can do financial engineering. From the bank's perspective, you can go out and lend imprudently. All those things. So if you can, the second aspect that I was mentioning is that if you can stay away from these tendencies and make efficient use of your capital, then you will reduce risk. But if you are imprudent, then risk enhances in the economy. This becomes more relevant today because India is on an upward trajectory and many companies will make a lot of money. uh, it is up to them to deploy that capital, prudently. If they don't, then that is a very big risk. I see these two big risks in our economy. One of policy stability, second of imprudent deployment of capital as the country makes and corporate India makes a lot of money in the coming few years.
One more question.
Thanks, Danny sir. He's not
Yeah,
audible to me, so not sure he's speaking or.
I,
So
I
Anshul sir,
can
no
I
okay, you
can
problem.
hear
can.
him.
Yeah,
Okay,
yeah.
okay. Sorry.
So, corporate debt is at
Yes,
one of the lowest levels.
right.
What do you think about it?
That just tells you that corporate India has, in this cycle, um, behaved very rationally, and they have cleaned up their balance sheets over a period of time, and there is sufficient room for these companies to build capacities because there is no debt on their balance sheets or very low debt. There is sufficient room for them to build capacities to take advantage of the favorable consumption cycle going forward. And this, in a sense, will become a virtuous cycle for the economy. If you noticed, in the recent GDP print that we saw, which was I think 7.5 or 7.7 for the last quarter, the two areas where India actually beat expectations were, one was construction activity, which grew by 13 plus percent, and second was manufacturing activity, which again grew 13% plus. Both of these segments actually beat expectations. Now, this tells you that investment in the economy is picking up. It has started to pick up. If that private investment picks up, it will have a favorable impact on consumption, and that will become a virtuous cycle because consumption is going up, so investment will go up. Because investment is going up, so consumption will go up. So debt low corporate debt is a precursor to economic I mean private investment in the economy picking up, and that leading to a virtuous cycle playing out in the economy. In fact, I remember Manmohan Singh used to say animal spirits. This is what animal spirits is all about.
Thank you very much.
Most welcome.
Thanks. So Anshul sir, before coming to next speakers, one quick question, although you somehow touched upon that. Any sense on the private capex and how it is, how you see it going forward from here?
Yes, Prince, actually, again, if you deconstruct the credit,
Is it me
Correct.
only,
We
or
are
nobody
seeing
is
that
able to listen?
while retail,
Okay. Yeah, sir, go ahead.
I can hear you, Chris.
We lost you for 10 seconds, so you can, I mean,
Okay. Yeah, I was saying that if you look at systemic credit growth, that growth is 15% plus over the last 1.5 to 2 years. But within this systemic growth, what is growing fast is the retail credit growth, as also agri, um, uh, uh, you know, um, and SME growth is also strong. But what is not strong is corporate growth, which is at about 6-7% still. Now, it is this segment of the market, this segment of credit, which is something that has to come up and grow in future. So far, much of the burden of capex has been borne by government, and they have been funding it through internal accruals. Uh, However, private capex has not picked up to the extent that is desirable. But given how corporate balance sheets are, and given how we are seeing, consumption growth pick up in the economy, and a perception of future consumption also picking up, it is only a matter of time that we see private credit growth also pick up, and private capex as a result pick up in the coming few quarters and years. And when that happens, that is really when you will see the true animal spirits pick up in this economy. Since that is ahead of us, it looks like, there is further steam. I mean, people are getting worried about economic activity today, but I think that there is substantial steam left in this economy, and this cycle is a 5-10 year cycle. We're only at the start of it. When private capex picks up, that's when we will see the real cycle, positive cycle, GDP cycle pick up in this economy. So wait a few quarters. I think that we will see that activity pick up as well.
right, sir. So, Anshul sir, we are good on time. We can like take another 10-15 minutes. It's okay with you?
It's fine with me. Yes.
Okay, great. So, Karthik, you can quickly unmute and ask your question, please. Mr. Karthik, you're still on mute.
Yeah, yeah, nothing, nothing. I'm listening.
Okay. So, Babulal sir, do you have any question?
Yeah, good evening, Mr. Anshul.
Good
So
evening.
my question is on percentage of manufacturing in the GDP.
Yes.
I've been avid follower of manufacturing because I am
Yes.
myself a manufacturer.
Yes.
I do frankly remember, or I do firmly read somewhere that any economy which has grown much faster is
Yes.
having manufacturing income around 20-25%.
Right.
So at what level India is and what level you expect the manufacturing income as a percentage of GDP to go up?
Yes, you're very right, Mr. Babulal. Actually, over the last 60-65 years, if there is one segment of the market, of the GDP, which has been ignored quite seriously, it is manufacturing. I mean, to the extent that simple furniture that offices need within the country needs to be imported from countries like Malaysia, China, etc. There is no reason why that cannot be manufactured within the country. But such has been the apathy towards manufacturing, and processes, laws which have been created in the country over the years, that manufacturing has really suffered in our country. Um, Having said that, in the last 3-4 years, really concrete steps have been taken to reverse this trend. One is one sort of metric which has changed is of course the PLI, production linked incentive scheme, which has been given to many sectors of the economy. Second is the Make in India theme, which is being propagated by government. It is being incentivized that people procure from Indian manufacturers rather than import from outside. And many incentives are being given for that, and disincentives are being put towards imports. Third, capital availability has been made relatively simple. Fourth, taxation within the country has been brought to levels similar to competing countries, and all of these taken together, baby steps have been taken towards manufacturing pickup in the country. Now, think of it that 8, 9 years back, we used to import roughly, I think, if my memory serves me right, about $4 to $5 billion worth of mobile phones from out of the country. And today, we are manufacturing 90 to 90,000 to a lakh crore of mobile phones within the country. Of course, it can be argued that most of this manufacturing is assembly. It is not proper manufacturing. For instance, we are not manufacturing the semiconductor chips. We are not manufacturing the batteries. We are not manufacturing the screens or panels of these mobile phones. But the first step is to create an ecosystem, and that has definitely been created. Now, since the ecosystem has been created, it will incentivize many manufacturers to bring in semiconductor manufacturing within the country, panel manufacturing, battery manufacturing within the country, and so that process has been put into place quite nicely. Similarly, in electrical goods, air conditioners, for instance, most of the parts of an air conditioner were imported from outside of the country till recently. But through the PLI scheme, manufacturing within the country has been incentivized. And through first-hand knowledge of this aspect, I can tell you that many of the Indian companies, as also MNCs who operate out of India, are setting up capacities for not only manufacturing ACs, but also parts of ACs within the country. And we should be in a position to not import anything other than the compressor from outside of the country over a period of time in the next, say, 1 to 2 years. So, in many aspects, steps have been taken. Manufacturing, if you ask me, the revolution that we saw in IT in the 2000s, that revolution in manufacturing is ahead of us in the next 5 to 10 years. So, your point that of GDP, manufacturing should be north of 20%. It is a very desirable aspect even in India, and it is the government is and the policy makers are well aware of this aspect, and they are working towards it. I think that revolution is ahead of us, and what it will do, of course, is that it will create many more job opportunities for Indian citizens than have been available in the past. So I'm quite positive on the manufacturing sector, which is a minuscule sector today, from here to the next 5, 10 years.
Yeah, I agree with you. There are so many missing links even today. Can you hear me, sir?
I can hear you, Babulalji.
Yeah, there are many missing links, like complete value chain.
Right,
I blame Reliance right and left every day for not
correct,
creating any value chain out of their petrochemical complex. This is just an example.
right, right.
So, unless the big manufacturer create raw material base at international price, how would medium and small companies depend on them to create further products?
Correct,
And
correct.
that has happened to some sectors, but it is missing in many sectors, particularly in chemical sector. We are still dependent on many things on China, also on many special alloys and special components. The value chain does not exist. We import the last item which is already value added there. So this need to be changed, and we need to track that. According to you, what is the percentage of manufacturing as of today in our GDP?
Uh, Again, I don't have that number at the top of my head, but if my memory serves me right, it should be in the range of say 13 to 15%.
Yeah, I heard last was 16%. I used to represent industry in our Chamber of Commerce, and I had always written there that prosperity will come only via manufacturing and it must be 25%. Unfortunately, what I export and what I make is all published
Correct.
by Chinese companies, not Indian companies, but Indian government doesn't give any data. So that attitude change is still required, which is missing.
Right.
Right, sir. Thank you. So, Anshul sir, like IT and chemical, you already touched upon that. These are two areas where the stocks have corrected a lot, and there could be some value. So, any select pocket within these two sectors to your mind? Obviously, no names.
You're saying IT
The
and
chemical
chemical.
sector, yeah. Yes, yes.
I think that in chemicals, fluorination chemistry is a very difficult process to get into and to master. And there are very strong fluorination chemistry manufacturers within the country, or who have done a great job in creating scale and creating products, basically creating processes to manufacture products, which are unique and which are value added, generating high margins, as also having the opportunity to cater to large volumes globally. So fluorination chemistry within chemicals is something that I think has a huge roadmap for growth over the coming few years. Um, in IT, I would say that companies that are, that are uh, not plain vanilla manpower suppliers, but which are catering to products and requirements of the future. That is either AI linked, IoT linked applications they are serving. Those are the companies where, or cloud linked applications, those are the companies where value will be created in the coming few years. Of course, there will be the odd company which will be trading at discount to intrinsic value, and where value unlocking will be an opportunity going forward. But by and large, if you want to compound your wealth in the IT sector, you would need to look at companies which are working for the in segments which are segments of the future. That's how one should be looking at that space, the IT space, that is.
Sir, any view around the agrochem space?
In agrochem, what has happened over the last year is that globally there has been a huge destocking, and that has to some extent impacted Indian companies as well. There has been a lull in that space, even in India. Also, there has been huge fluctuation of raw material prices, and that has led to margin pressures on many companies within India as well. I think that given that there has been 2 to 3 years of consolidation in this space, and that inventories have corrected over the last year odd, there will be opportunity in agrochem space going forward. Valuations are reasonable. We are starting from next year, we will be starting from a level where inventories are scarce in the system. And as a result, there could be opportunity in this space going forward over the next, say, 1 to 2 years.
Right, sir. Although the pharma and healthcare space is a heterogeneous space, and there are that the companies are sectors in themselves. But again, any pockets within the pharma and healthcare you are positive about with a view of say 3 to 5 years down the line.
I think one should look at the CDMO space within pharma and healthcare, and look for manufacturers of complex generics much more than simple generics in that space. I do believe that the down cycle in the US pharma business, that is exporters from India to the US, That segment of the market has seen a severe consolidation over the last many years. That is on account of course, their margins contracting, volumes also coming off because there has been price declines in the US market in pharma. That phase of the market is behind us. There is shortages of generic drugs on US pharma racks, which will mean that price declines will have to stall at some point. Probably this is the year where price declines will stall. And if that happens, then the decline in margins is a thing of the past. And with consolidation in valuations over a 7-8 year period, valuations in this space look attractive. So CDMO and exporters to the US, I think that that is where one will have to look for opportunity. I won't say that this is a broad-based opportunity by any company here, but do more work and identify opportunities in these segments of the market.
Right, sir. So last two questions, sir, if you allow. Yeah.
Please, very
Around
happy.
the sugar sector and seeing the scarce rainfall, especially in the areas like Maharashtra and Karnataka. So, what do you think, like, how this sector can do from here, in the sense like shortage and the ethanol thing as well?
Um, I think that there is going to be, I mean, no, it is not my opinion. This is the opinion of the industry body that there is going to be a significant decline in production in sugar in the coming sugar season because of what you rightly mentioned is scarce rainfall in Maharashtra and Karnataka, and production from these states has come off. These are, bear in mind that these are monsoon-fed sort of states, unlike UP, which is river-fed in many ways. And as a result, what we may see is upward pressure on sugar prices. Already, sugar prices are trading at about 40 rupees to a kg. And these prices about a year back used to be 35, 36 rupees. So there has been a significant increase. And if there is a failed monsoon next year as well, then there will be further upside pressure to sugar prices. Now, what we have seen, I mean, today's news is that the government is going to ban A heavy, B heavy manufacturing of ethanol, and they will allow only C heavy ethanol to be manufactured. This is indicative of the pressure on sugar prices and governments intend to control sugar prices, or to have stability in sugar prices and not let them go up further. But it, when government comes in like this, you know very well that there is upward pressure on sugar prices. Um, with each rupee of sugar price appreciation, there is significant profits that come to sugar companies. So, so it is likely that sugar companies will see very strong profitability in the quarters and years ahead. And there is also a shortfall globally of sugar. If that compounds, then global prices can go completely berserk. So so sugar as a commodity has very favorable trends on pricing, unfavorable trends on volume, and that should lead to profitability within the sector going up, and that hopefully getting reflected in valuations as well.
So we talked about, like, everybody knows that we are very in a very sweet spot, and India as a economy is going to do good for next 5, 10, or maybe more years. So the infra and logistics space is one which should, I mean, grow in proportion to the economy, right? So what are your views around these, the infra and logistics space? Do you think material or structural change on ground, or it's more in the narrative only, or it's actually happening on ground? What's your view around that?
Uh, Prince, no, I think that, I mean, you can be cynical and say that this is narrative, but people who actually travel by trains and who have traveled over the last 20 years or more by trains, they will agree that there has been a marked difference in how train travel has transformed over this period, from not only the infrastructural upgrade that many stations and trains have seen. It is also cleanliness which has changed quite favorably over the last, say, 5, 10 years. Similarly, if you are a traveler to the hinterland by flights, you will notice that the number of airports which have come up in smaller cities, is really a revolution, and it has changed air travel within the country by a mile. Road travel. I mean, anybody who travels between Delhi and Dehradun will vouch for it that what used to take 5, 6 hours to travel now takes 3 to 4 hours to travel. I mean, that much of a time differential has come about in the travel between these cities. So also many other cities within states. I mean, Gujarat, Maharashtra, the quality of roads that has improved materially. I mean, it's not like there are no bottlenecks, there are no problems in infrastructure. Of course, there are. But is the trend positive? I think that is an emphatic yes. And as a result, you can, you know, I mean, one is this aspect. The other is you can ask me a question that what about kind of uh, transmitting into companies. Now, if you look at companies, you will notice that many companies in the infra space have died down because they didn't manage their balance sheets right. And when the cycle became unfavorable, many of these companies did not have the wherewithal to kind of stand against the unfavorable cycle. The companies that sustained their business and who remain today are companies who have strong balance sheets and have healthy, robust businesses, real businesses on the ground. So that is where opportunity lies. You have volume growth within the economy because there is definitely a tailwind on investment in infrastructure, and the companies that remain are quality companies with reasonably strong balance sheets. And might I say, valuations being reasonable in many instances. So opportunity is definitely there, both in infrastructure as also in logistics. Pay the right price, buy the right companies, look for managements who work in favor of both minority shareholders as also majority, and unlikely over a 5, 10 year period you will go wrong.
Right, sir. Greatly said. And sir, one quick question on the front, like there are house divided when it comes to business to government companies, B2G companies, right? So the change which has happened over a period of years, do you see that as a structural change, or it's more of a cycle, and how you see
What
this?
kind of B2G companies? Can you just
Be, be, be
tell
it the
me?
PSU space broadly, PSU banks and the companies of the likes of the PSU, big PSUs company.
Um, I, okay, let me answer this with anecdotes. I have been over the last few years meeting many PSU companies, and I have noticed that over the years, PSU companies, who were very reticent in talking to investors, have become much more open in talking to investors. This is a nudge that they've got from government side, that you have to go out and talk to investors and communicate your story well to them. This is number one. Number two, they are the government is nudging companies to manage their capital well, to deploy it well within the businesses, or pay it out as either dividends or buybacks to investors. I mean, you would recall recently that there was a government of Gujarat directive to pay either dividends or do buybacks in Gujarat PSUs, I think that that will become a model for the rest of the country and PSUs across the country, that they will have to look at giving back capital to shareholders. Third, when you have gone through such a tough phase as PSU banks have gone through over the last, say, 10 odd years, and many PSU managers as also other people who have been borrowers from PSU banks. Those people are either absconding or cooling their heels in the prisons. Um, that acts as a huge disincentive for mala fide intent to come back to the system. And many of these banks, they will, I mean, I don't think that they will have the incentive to become as efficient as private sector banks, but also they have the disincentive to not be as inefficient as, to put it mildly, as they were in the previous cycle. So we will have somewhere in the middle kind of operations of these banks. And as a result, they will get multiples which are somewhere in the middle, not zero point 0.2, zero point 0.3 times price to book, but also not 3, 4 times price to book, which private sector banks get. So somewhere in the middle is what they will get as multiples. And I must mention that many of the PSU companies are very high quality companies, and in their own right, they are monopolies or oligopolies. And so they are quality businesses generating high returns on equity. It's just that their ownership is government, and which is why investors are averse to looking at these businesses. But these are, as I said, quality companies, and they will offer opportunity from time to time.
Great, sir. We can say we are on the right path, and I must thank you for your time, sir. I mean, great nuggets and great examples so as to make us understand the framework of the art of investing. Thank you so much for taking out time today, and lovely thoughts shared with our audience. Thank you so much. Any concluding remarks, sir?
Thank you, Prince. Thank you very much for inviting me and having me on your Twitter spaces. Thank you, everyone, for taking out time and listening to me. I hope I've been able to add value. You have my Twitter page. You can always reach out to me, and in case you have any further queries, I'll be very happy to address them. Thank you again. Thanks, Prince. Lovely talking to you all.
Thank you, sir. And for our audience, those who joined late, we have recorded this session and I'll be uploading this on my YouTube channel. So if you have missed any portion of this session, surely you can revisit. And as sir said, if you have any questions around the discussion we had or any other question related to market, of course, don't ask about stock specific questions. Please feel free to reach out to sir and he'll be happy to help on that front. With that note, thank you so much and good night. Take care.